Hello everyone. Today we are going to discuss about the biggest crash, or in fact I would say almost every crash which has happened in our Indian stock market since the inception of Sensex. So why I have taken Sensex instead of Nifty is because Sensex is incorporated much before Nifty. That is, Sensex is available since 1979 and Nifty, if you see, it is just from 1995 since NSE has been incorporated. So why this analysis of crash? So nowadays everybody is under fear that there is recession, the stock market is going to fall, what will happen to my investments? I am in a panic mode. Should I sell? I am going to sell. I am going to sell and keep the cash in my FD account because my FD interest rates are much higher than my Nifty returns or index returns. Or if the crash happens, then the effect of that or the impact of that crash will be there for coming next 5 years. So what will happen to my money? Say if I had invested 5 lakhs in last 2 years, then it has moved nowhere, or say it has eroded by 50%, etc., etc. So my subscribers or the investors which I know are very much concerned these days about the probable crash which is going to come, and is it real, or what happens after a crash, or what is a crash, and how the market has moved after a crash or post the crash, or how the market will be performing going forward. So all these are concerns of various investors, I hope including you. So I am here to give you a analysis of all the crashes since our stock market in India has been incorporated, and then you only can decide, or I will also give you a conclusion of what has happened after the crash and why the crash has happened, and what is the takeaways from the various crashes which has happened and which is about to happen as well. So let's directly get into the topic. So what is a stock market crash? So it is a significant decline in the stock prices of various stocks, including the various stock market indices like Nifty, Sensex, etc. So normally a stock market crash is told only if the market falls, market in the sense the indices falls in a 2-digit value, say more than 10%, I would say. Some of the stock market crashes can have deeper impacts on the economy and on the society. And also, if you see, as I mentioned in the Alchemy of Finance session, the earlier session 73, there the stock market investors have a perception about the future stock prices and they trade in the market. So not only the fundamentals of the stock, but also the perception of the investors will affect the day-to-day volatility or the up and down of the stock prices. So day-to-day volatility going up and down is say 0.2 to 1.5% is normal. So that cannot be taken as crashes. But real market crashes are percentages more than 10%, wherein you have a large crash in the market. So we are going to probably analyze such greater crashes which has happened over the period of time. So the Sensex, the sensitive index, the short form of sensitive index is named as Sensex. So this is normally considered as the pulse of the Indian market, Indian domestic market. So Sensex was incorporated with its base value as 100 since 1979. So if you see the earlier charts, you can see the stock has started from, or the index Sensex has started from a base value of 100, then it has gone up and down, etc. And now we are around 60,000 value, 58 to 60,000, which varies day by day these days. So in that range currently. So from 100 to 60,000 has been a very long way. So since 1979 to now we are standing at 2023. So you can imagine the curve has always been towards the up. So as we say in market, the only way is up, but you will have a lot of up and downs, but end of the day the market will move always up. This is for sure. As far as the population is increasing, the demand is increasing, the technologies are coming in, the technologies are evolving, the businesses are expanding. So obviously the stocks which are basically representing those businesses which are expanding has to go up. As far as the profits increase, their revenue increase, and the size of the business increases from small, mid to large caps. So that is very clear that the markets are going to go up always. That is, I can predict, or anybody can predict. But only thing is that when it will go up and when it will go down is something which is questionable. If you see, BSE is incorporated since very long. NSE is incorporated in 1994, 1995. Watchdog of stock market, SEBI, was incorporated in 1988 to 1992. Till 1995, we used to have the ring trading, in the sense you would have seen in the Harshad Mehta scam series or the Big Bull movie and all. wherein there will be a lot of people quoting the prices, standing in the BSE ring and shouting out the values. So that physical way of trading was discontinued in 1995. The same year, the NSE was also incorporated, and then the online demat accounts and the trading through online platforms were started. So on my chart, you can see this is the chart which I was telling, the Sensex which started in 1979. The curve has always been up till now. So currently, snap which I have taken, the Sensex is at 58,000. So the curve has always been up. So now to explain the complete thing, I have split that time periods into 1979 to 2004 and 2004 to current 2023 date, because the values are very low in years from 1979 to 2004. So to have a proper graphical representation and scale in the curve, I have split it into two time zones. So you can see the split on the screen into two time zones. Now the first time zone, which is from 1979 to 2004, you can see on the screen. So you can see zigzag curves, which is the in Sensex going up and down because of various events. So if you see the next slide, in this I have marked each and every crashes which has happened and the reason for that. If you see, first one is 1987, first major crash, the Black Monday program trading. So it was like there was computer programming done mainly in US, wherein you have this automated trades. So if the stock prices are going down, then this program automatically gives a sell order for number of shares. So if a small selling is activated, then a huge number of sells are activated by the program, and then the stocks will be sold. So this has led to a very huge dip in the market. This was a particular Monday, so hence the name Black Monday. The crash was in the period of 1987 to 1988. Then there was again an uptrend. Then 1990, you had this US recession. So at that time also, obviously, India is very much related to US. So because of that, that impact had that thing as an impact on India as well. So we also dipped. So then 1991, we had this national economic liberalization. So this were like a good breakthrough for foreign institutional investors, FII. So there are a lot of money coming in. There was some ban or there was some cap on the investments to be done in India. Now that was removed by the particular government. Then in that case, there was a lot of cash inflow into the Indian market. So then again, the market boomed till a very high value. So you can see it has reached up to 4,500 levels from the lower 1,000 levels of Sensex. Then in 1992 came the Harshad Mehta scam. So that about the boom and bust cycle of Harshad Mehta. He had pumped a lot of money into the market. Then there was a boom. Then there was a bust. So I will not explain much about the Harshad Mehta scam. A lot of videos or articles are available on that. If you want a separate video, you can comment me. I will do that. Then after the Harshad Mehta scam, again the market came down to 2000 levels. Then again there was a up move. Then in 1996 there was another market crash. Then in 1998 there was global financial meltdown. So again the stock fell down. Then in 2001 there was dot-com bubble. So because of that there was a lot of investments done in the internet space or the IT space. Then the people were thinking that going forward there is a lot of future for IT sector. Then they had invested a lot. Then the valuation was too high that more than profits, the price of the stock has gone based on the perceptions they had invested. Then on realization, the actual profits were not there. Then the stock market again fell and normalized. Then again there was a boom. Then in 2004 there was a UPA election crash. So there was the change of government. So based on that, the investors were really concerned. Now on the screen you can see the next portion, which is from 2004 to present 2023. So if you see the earlier patch of 1979 to 2004, the curve, which is the up and down, is very vigorous. But if you see the second phase, which is 2004 to 2024, the zigzag is lesser. Probably because the regulations were not in place at that earlier times. There were learnings for many countries and markets, and new regulations were brought in, and there was immaturity among the investors, whether what to do with their stocks, whether they have to retain or panic mode, lack of information, etc. But as time progresses, there is more information available, more realistic data available, things like that. So because of that, you can see the corrections are somewhat lesser compared to the earlier times, but still you have got good corrections that we'll be discussing here. So on the screen, if you see 2006, we have this weak global market plus inflation. So similar inflation times we are facing now also. So there was a correction. Then in 2007 to 2009, which is 2008, housing bubble, the financial crisis. So there was a huge dip. So there was mortgage crisis. So there was excessive loans given. So there was default on the mortgage loans. Then there was a big housing bubble issue. Then there was a huge crash all along the worldwide, including India. Then again there was 2011, there was FI selling, like we see now. Then 2015 to 2016, there was Indian Bank NPA, non-performing assets issue. Global weakness was also there, and there was demonetization introduced. So there was a crash at that time. Then going forward in 2018, there was a rising US bond yield. So there was a huge FI selling. So you got a downtrend at that time. Then in 2020, there was a deep financial crisis because of COVID pandemic. So it was a quick correction, but it was a deep correction. Then in again it gained pace in 2022. It was a very small recession time, the shortest recession time in the complete financial history. Then in 2022 you have this Russia-Ukraine war plus inflation. So then there was a crash. Then there was a market correction. Then again now you are in 2023. Now there is fears of recession. There are fears of inflation, higher interest rates. So inflation is increasing. So people are having higher energy bills, product costs are high, CPI inflation is high, then geopolitical tension is also high, China, Russia, etc. So because of that, there is a current fear of recession also. So if you see overall, over the period of time, the corrections are there, short-term volatilities are always there, but the market is always going up. No, if not in a straight line, but always it is going up. So you need to be patient enough to give time for the market, so that the corrections will be there, but healthy corrections are required for the market to achieve higher heights. So now the important thing, what are the major takeaways from the market crash analysis? So it is very clear that market always goes up if not in a straight line. As I mentioned in my session 73, the alchemy of finance, investors will have their speculations. Based on that, they have a perception of the future prices of the stock. So they anticipate, they speculate, they invest, they sell, they buy. Demand and supply is based on their perception as well, in addition to the fundamentals of the company. The fundamental value is something, but also the perception or the future anticipation of the investors also plays a role in the short-term volatility, even in turn long-term volatility of the stock prices. So first point is that, as I told, market always goes up even though there will be short-term volatilities. Always avoid herd mentality. So if people are selling, you go and sell. If people are buying, go and buy. It should not be the strategy. You should have your own analysis. As Warren Buffett once quoted, be greedy once others are fearful. So that is like going against the herd mentality. You should also know that market always bounces back. So from the analysis which I have shown earlier, you are very clear that market always bounces. So don't worry about that. Just don't give ears to your short-term volatilities in the market. Market will always go up. So be confident and just keep investing. Another thing is that you don't always have to act or do something in the market always. Like if there is a correction, you have to invest. If the market is going high, you have to sell. Nothing like that. Even sitting on cash and not just doing anything is also an intelligent way of facing the market volatility. So if somebody tells that the market is crashing, you have to invest. This is not a need. So if you have cash, if you find a fundamentally strong stock going down, then you can invest. But if you don't find that, you can always stay in cash and wait for the right time to invest in a quality stock. Another thing is that don't fall trap to the liquidity trap by the central governments. So for an example, in India, RBI is there. In US, there is Federal Reserve. So they try to infuse money into the economy at times of crisis like COVID. So they call it as quantitative easing, wherein he buys back the bonds, then injects money into the economy so that they get liquidity in the market to invest more, to buy more, and to increase the consumption and to boost the economy. And conversely, if you have an inflation currently, what we are facing post-COVID, so because of the higher quantitative easing in US, there is a very large inflation, unlike India, wherein the quantitative easing was very minimal here. So the liquidity injection into the economy was not that high. It was in a mature way in India, unlike US, wherein there was a lot of quantitative easing, lot of money printing. So they are facing the after effects of higher inflation, uncontrollable inflation. So now it has gone to stagflation. So stagflation, regarding stagflation, I have mentioned it in my earlier session, in the video session. You can go and watch that. So the thing is that because of this, the inflation is completely out of control, and the government or the central bank keeps injecting money and sucking liquidity out of the market. So you don't, or you should not, as an intelligent investor, be trapped in such liquidity traps. So you should have your own view of or analysis of the market and your stock, and stay invested in a punctual and systematic way. Always avoid selling stocks in a panic mode. Be a intelligent investor, be a stable or mature investor. Have your own analysis. Give time. No train is missing for you. You can catch the other train as well. If a train misses, there is another train. So an opportunity also is like that. Once an opportunity goes, another opportunity will definitely come. Market is going nowhere. You will get good corrections. You can invest money, if not this time. So you should be mature enough to understand the game of stock market and how to invest in quality businesses. Never stop your SIP, systematic investment plan, or your systematic equity plan in your stocks, or systematic investment plan in your mutual funds. It will help you fight against the short-term volatilities and create a compounded wealth. So never stop your SIP. So as I told, it's not necessary that you have to invest lump sum in a market crash, something like that. You can always remain in cash, wait for an opportunity. Others may do that, they may have invested, etc. So you have your own analysis. So it's not necessary that you have to invest lump sum. If you have cash, be in cash, wait for the right opportunity. It may not be in a crash time, or maybe in a crash time. Your stock has nothing to do actually with the index. Index can go up and down, but you have to be stock specific and your portfolio specific, and stay invested and concentrate on your own portfolio rather than concentrating on the overall market scenario. Bear markets can be for long, so it can be there for 2 years, 3 years, etc. So you need to be diversified enough to kill or to mitigate such short-term volatilities. So like earlier videos we had mentioned about commercial real estate, that like platforms like Strata. Then you have got gold, you have got bonds, though bonds are not that attractive these days, but still you can look into that. Then you have corporate FD, and these days you are getting higher interest rate on FD also, so some minor amount you can invest there as well as an emergency fund. So you need to have a diversification of funds. Also you have this cheaper homes you are getting at a lower rate at an undervalued location. You can invest in them, and then you can go renting out that flat or the commercial space and get the cash flow. So that will ensure a cash flow. Even though your stocks are underperforming, they are not giving dividends, still the cash flow from other assets will ensure that you are well diversified and you are not going dry on your income. So end of the day, stock market is not for light hearted, impatient, or immature investors. It is for people who are really mature enough to understand the scenario, analyze the situation, go deep into the stock analysis, understand the business, understand the modes surrounding the business and the value proposition, and identifying undervalued stocks and investing in them. So hope this analysis of crash from 1979 to 2023 and their takeaways has helped you, or maybe it will help you in your ongoing investing journey. If you have any suggestions or comments, please feel free to comment in the below comment box. If you like the content, please share the video, like the video, subscribe to my channel so that you will get notifications of similar content. So hope this session was useful for you. See you in next video. Till then, happy investing.